let's talk about what's going out there on the markets at the moment. I mean, it was a choppy session on Wall Street, but very, very low volumes coming through the US, and I think that's probably filtering through to what we're seeing out here in Asia at the moment. Any clear direction for you at the moment?
I think the direction is the question mark. I mean, the question mark still is very much, is a sort of a bear market rally, or is it a sustainable upward move? And I think if you look, I mean, many people have different opinions, right? I mean, media is always full of opinions. And I suppose, look, the real question is, what does price action tell us? And price action tells us that we're in a yearly downtrend, but in a monthly uptrend. The real question is whether we move into a yearly uptrend. I mean, oil is the same thing. Oil at $42 a barrel.
The short answer is, will we?
Is at the yearly trend line. And I personally think that this rally we saw potentially now could be due for a pullback, because often in order to make money, often you have to do what's uncomfortable, counterintuitive in a sense. Yeah. If the right decision was in mid-February to go massively long, because markets were very oversold, now technically a lot of markets actually look very overbought.
So you would actually be selling into what we're seeing at the moment, the strength that we're
I would reduce risk, yes. Because I think the underlying fundamental economic problems have not really been solved yet.
Because in other words, you think we're going back to this yearly downtrend?
Potentially. I think, we're still in the yearly downtrend. I think that most probably clarity with regards to global growth is still somehow questionable. I mean, a lot of conflicting news is out there. I mean, everything is still based on central bank policy.
Are you talking about this, overall with the equity markets, or are you talking about oil in general, or oil specifically, rather?
Both, actually.
Both?
Yeah.
So we are not going to make this yearly downtrend, but this monthly uptrend is not going to turn into a yearly uptrend for either?
Look, I think the probability is quite high that we could see a pullback. I mean, oil back to mid-30 levels, I suppose, is a high probability, because I think the supply side is still very much the issue. There's still a lot of supply because demand is still to some extent static. I mean, demand is not really growing, and global growth is still to some extent weak. What we have seen recently, especially since the Shanghai meetings, sort of renewed central bank coordination, if you will, to further commit to stimulus, whether it's the ECB or even the Chinese central bank. And I suppose that to some extent is short-term helping risk, but fundamentally it's not really changing much, because the way I look at China is that they are actually they have short-term gains for long-term pains, when I think should do it the other way around. Have short-term pain today for long-term gains.
What would you have them do?
Look, I mean, that's a good question. I suppose the real dilemma also comes down with the stock market. I mean, the stock market crash that we saw last year gave a lot of ammunition to anti-reformers in China, who said, look, let basically the market, let not the market be so free. And I suppose what China needs is more capital market liberalization, and also fundamentally need to fix the debt problems, which have not really been fixed. I think they're just being avoided, they're being shifted around. But I think the underlying debt problem in China is very significant.
Okay, so they need to reform. Are they going to reform? Because all the, the speak that we're hearing out of these very important MPC meetings is very, very forward-thinking.
Correct, and then don't forget they're in a very difficult situation, and a country that size is very difficult to sort of transition the economy, and they've tried that. And I think now recently they improved their public relations and the way that China potentially is now better in engaging with the markets, and that's why I think we've also seen this risk-on rally again, that the sort of belief that the Chinese could devalue the currency is a little bit off the table. But I think the fundamental reasons why there's demand, or why it would be in interest to have a lower currency, I think have not gone away. So that comes back to this belief that yes, potentially this risk rally could run out of steam.
And it's not just that. I mean, you're looking at for this year, 2016, you're looking at developed markets potentially going into a bear market. It's going to be that bad?
Yeah, look, I mean, it looked like when we went into the year that we were going into a full-fledged bear market. Then we had this major relief rally. But then if you looked at the speed of that rally, that's usually a sign of a bear market rally. And it's usually sort of the higher risk asset that actually went up the most.
But did anybody expect it to last this long?
Yeah, maybe not. That's right.
I mean, the volumes have been all right? So it seems to be a fairly sustainable rally. But then again, you're saying that the chances of actually pulling back from here are fairly high.
Yeah, I look, technically the market looks overbought and we're running into key resistance areas. And I think, look at the S&P 500, right? We had a 200-point move on the S&P 500.
Yeah.
Now at this 20, 40, 50 level, it looks like, yeah, there's technically strong resistance.
It's positive for the year now.
Yes, correct.
Yeah.
The question is whether we take this big leg higher or whether we pull back. I think historically there's a probability that you see a pullback. And the pullback would be healthy because these huge swings, it's a bit on oil, is actually not healthy.
What's the catalyst for the pullback?
Still fundamental underlying growth problems. And if you think about back, I mean, Martin and I discussed this for many years. I mean, since 2000, right? In the year 2000, global debt was roughly $40 trillion.
Yeah.
Today, global debt is around $225 trillion. So the debt burden gets bigger and bigger, slowing down global growth. And what central banks have done, they always postpone the day of reckoning. And I think that has not gone away. I think this is why also in these markets, it's about capital preservation. It's
Because
about
there's going to be a purge at some stage, is what you're saying, still.
most probably, yes, correct. I think this is not a market to be complacent. This is a market to use the recent rally and rebound to look at where you potentially could put in place portfolio hedges, some portfolio diversification, even some strategic hedges.
You'd use currencies to do that?
Well, currency is partly the problem because this currency war that we're seeing. I mean, most equity market moves are driven by the currency market.
Yeah.
And look what happened in the yen and the
Japan,
Nikkei.
yeah.
Most banks, international banks, are positive on overweight Japan, but Japan has actually underperformed, especially since they introduced negative interest rates. And I think the currency angle is the problem. So I would rather say that currency and the dollar most probably is sort of also going more range bound. Most probably has peaked out as well.
Right, okay. So where would your hedges come from?
Gold is one, but also I think portfolio hedges in the sense of some short positions to offset the long exposure. But I think just net long only at this stage, after this rebound, potentially would be wrongly positioned. I think long-short strategies, because I don't think volatility has ended. I think volatility is here to stay, and most probably for the year will be flat, but in between the year there will be a lot of trading opportunities like we've seen. So tactical asset allocation most probably is appropriate.
Okay,
Good
this
stuff.
is just
Be
a
active.
lull.
Yes.
There you go. Thanks, Michael.
Thank you very much.
Michael Price there, Taurus Wealth Advisors, with us here at the SGX.